Would you like to own a slice of a global business that benefits from an aging population? Want to buy a stock that has one of the longest dividend growth track records around? Like the idea of investing in something that offers a yield more than twice as high as the broader market? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is running one of the world's largest retail pharmacy chains. With the world growing older, richer, and larger, demand for and access to quality medicine is only going to go in one direction, up, and this business benefits from that. I've personally invested in stocks just like this one on my way to going from below broke at age 27, financially free at 33. Best of all, stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Walgreens Boots Alliance Inc., which appear to be trading at a significant discount today. Walgreens Boots Alliance Inc., stock ticker WBA, is one of the world's largest pharmacies with more than 18,000 stores across the world. Founded in 1901, this is now a $32 billion by market cap pharmacy giant that directly employs more than 275,000 people. Some of their major brands include Walgreens, Duane Reade, Boots, and Alliance Healthcare. The company's revenue is split across three reportable segments: Retail Pharmacy USA, 75% of fiscal year 2019 sales, Pharmaceutical Wholesale, 16%, and Retail Pharmacy International, 9%. Walgreens is primarily a retail pharmacy operator, and the retail pharmacy business is largely a US-based one. Their 2018 acquisition of nearly 2,000 Rite Aid Corporation stores for $4.2 billion doubles down on that strategy. However, the company also owns approximately 26% of AmerisourceBergen Corp. This equity ownership in AmerisourceBergen exposes Walgreens to pharmaceutical distribution, as AmerisourceBergen is one of the largest wholesale drug companies in the US. Their big bet on the US retail pharmacy business is a double-edged sword. On one hand, they're a leader in the largest economy in the world, and with Americans getting older, the need for pharmaceutical products is sure to rise. Aging wealthy people will pay to access quality medicine. A world that's growing bigger, older, and richer means demand for and access to quality medical care is only going to rise. On the other hand, the US is a mature market, and the rise of e-commerce makes the thin margin retail business even more competitive, while also allowing for the shipment of pharmaceuticals. The pandemic isn't helping either. Still, Walgreens has scale where scale matters. They're an integral link in the complex supply chain that makes up the US healthcare system, and that bodes well for their ability to grow their profit and dividend. The company has already increased its dividend for 45 consecutive years. That's getting near dividend king status, which would be 50 or more consecutive years of dividend raising. Basically, it's dividend royalty. However, while the 10-year dividend growth rate of 13.6% looks fantastic, recent dividend raises have been anemic, and that's because business growth has been anemic of late. On the other hand, the payout ratio of 39.5% against trailing 12 months adjusted earnings per share indicates no issue with the dividend's sustainability. Indeed, Walgreens notably increased the dividend by 2.2% back in July during a pandemic. This growth comes on top of the stock's mouth-watering yield of 5.0%. That yield, by the way, is 280 basis points higher than the stock's 5-year average yield. Looking at business growth, Walgreens increased its revenue from $72.184 billion in fiscal year 2011 to $139.537 billion in fiscal year 2020. That's a compound annual growth rate of 7.60%. This looks great at first glance. However, much of this came from a big bump in revenue in fiscal year 2015, following the merger between Walgreens and Alliance Boots. Meanwhile, earnings per share advanced from $2.94 to an adjusted $4.74 over this period, which is a compound annual growth rate of 5.45%. This is a more accurate picture of what kind of growth this firm has put out over the last decade. It's a solid number, not outstanding, but pretty good. Now, I used adjusted earnings per share for fiscal year 2020. The pandemic and some other issues caused a very messy GAAP earnings per share picture for the last fiscal year. I think the adjusted number captures a fairly accurate picture of profit, as it's similar to where free cash flow is at. Looking forward, CFRA is forecasting that Walgreens will compound its earnings per share at an annual rate of negative 6% over the next 3 years. They see headwinds exceeding tailwinds over the next few years. This primarily relates to the pandemic negatively impacting the business in a variety of ways, including less foot traffic, tightening margins, higher costs, and a weaker cold flu season. I don't disagree with CFRA's take on the near term, but it's important to balance this against both the long-term picture and the current valuation. This is near-term fragility, and it doesn't exist in a vacuum. I think the business is still positioned nicely for the long term. Demographic trends work in their favor, even if the near term looks ugly. Furthermore, the valuation already prices in terrible performance. In fact, the valuation prices in terrible performance in perpetuity. Unless the business totally collapses, which appears unlikely, the low valuation and high yield presents a compelling long-term opportunity. Moving over to the balance sheet, the company maintains a good financial position. The long-term debt-to-equity ratio is 0.59. There is no applicable interest coverage ratio for the last fiscal year because of the messy GAAP numbers I just mentioned earlier, but this number came in at over 7 for fiscal year 2019. Profitability is as one would expect for a business model that counts on thin margin retail. Over the last 5 years, excluding fiscal year 2020, the firm's average annual net margin of 3.44% and annual return on equity of 15.71%. To be honest, this isn't the most attractive business model I've ever seen. But the yield and valuation go a long way toward increasing my enthusiasm. And with economies of scale, brand power, and its entrenched position in the complex US healthcare chain, there are competitive advantages in place. Of course, there are risks to consider. Regulation, competition, and litigation are omnipresent risks in every industry. Competition is especially brutal, both in retail and on the pharmacy side, with rising risks and costs as it pertains to omni-channel sales, especially in e-commerce. This is a concern. The company's scale works against them in some ways. It's the law of large numbers at play. Their large size simply reduces the amount of future growth they can produce in percentage terms. There's also political risk, especially on the healthcare front. Any moves toward the nationalization of US healthcare, however unlikely, would impact this business model. And with competitor CVS Health Corp moving toward a vertically integrated healthcare provider model, Walgreens' decision to double down on the core business model increases their exposure to structural changes in pharmacy retail. With these risks known, I still think the stock warrants attention here. It's down 42% from its 52-week high and deeply into value territory now. The stock's price-to-earnings ratio using adjusted earnings per share is sitting at a lowly 7.9. That's well off of where the broader market is at. It's actually one of the lowest PE ratios I know of. The price to sales ratio of only 0.2 is less than 1/3 of its 3-year average of 0.7. Then there's cash flow. The price to cash flow ratio of 6.0 is much lower than the stock's 3-year average price to cash flow ratio of 9.8. And the yield, as noted earlier, is substantially higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 9% discount rate and a long-term dividend growth rate of 4.5%. This dividend growth rate is materially lower than what the stock has proven out over the last decade. There's also the low payout ratio and mid-single-digit long-term earnings per share growth to be optimistic about. But with recent dividend raises being small, the pandemic still raging, structural business model concerns, and CFRA's near-term earnings per share growth projection being so negative, I think it makes sense to err way on the side of caution in this case. Walgreens doesn't have to do much to grow the dividend at a 4.5% annual rate from here. They basically just have to avoid a complete collapse in the business model. I'm modeling in very low expectations. The dividend discount model analysis gives me a fair value of $43.43. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Walgreens as a 4-star stock with a fair value estimate of $42. CFRA rates Walgreens as a 3-star hold with a 12-month target price of $42. We have a tight consensus here. Averaging the three numbers out gives us a final valuation of $42.48, which would indicate the stock is possibly 14% undervalued. Here's the bottom line, guys. Walgreens Boots Alliance Inc. is a global business with scale where scale matters, and they're set to benefit from demographic changes. With a market-smashing 5% yield, 45 consecutive years of dividend raises, a moderate payout ratio, strong dividend growth, and the potential that shares are 14% undervalued, this is a stock that should be on the radar for every dividend growth investor. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so that you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This six-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is and am often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.